Welcome back to the channel Sagely Investors. My name is Crass, and in this video I'm going to be covering a topic that probably gives a lot of people trouble, which is that of franking credits. So I'm going to leave a couple of different timestamps below so that you can access whichever part of the video you're most interested in. But basically, I'm going to be covering, number one, what franking credits actually are with a couple of examples. Number two, I'll be talking about how much you can expect to reduce your effective annual tax rate if you have a portfolio that is partly or fully franked. And this example will be for people who are, like myself, on a salary and have a portfolio on the side. And thirdly, I'm going to be talking about whether you should only go for companies that pay franking credits. Is that a good idea or a bad idea? And all of this, in the backdrop behind all of this, of course, is that big word, superannuation. So it has to be said that franking credits really power your final return when it comes to your super, and that has everything to do with the tax implications behind super accounts. So keep in mind that franking credits at the end of the day are going to be most tax effective in a superannuation account, but we'll get to that towards the end of the video. So if this is something that you guys look forward to, please stay tuned. Alright guys, as always, before we jump into the video, a little bit of ass covering. Obviously, I'm not your financial advisor. I know you wish I was, but I'm not. So take everything that you hear with a hefty dose of skepticism and another table serving of do your own research and contact your own professional authorized financial advisor. Okay, with all that said, let's jump into the video. In this example, what are franking credits? I have given you guys two different examples, and primarily the difference between the two examples has to do with your side of the equation. So in the first example, example one, you're earning a gross salary of $100,000. In the second example, example two, you're earning a gross salary of $35,000. Very shortly, you'll see the reason why I've done this, and it all has to do with the marginal tax rate being greater than 30%. And less than 30% in the second example, but that'll all become clear. So one thing that I found very annoying in years ago when I was doing my research behind franking credits and trying to understand what they are, is that a lot of the online resources basically end up confusing you more than they end up helping you. So you need to see the full picture here, guys, to understand what they actually are. And I hope that with this video, I will finally lay the confusion to rest. So perk up, drink your coffee, pay attention, boys and girls. You're going to learn what franking credits are once and for all. All right, you ready? So there's a company side of things, okay? First of all, what the company's doing. Then it's what you're doing, right? And I've split it between you not investing in this company and you with an investment in this company. And of course, what the government is getting from companies and from you and what tax they end up keeping. And this is the little piece of the puzzle that will hopefully give you guys that aha and will explain everything. So follow along. All right, so we have a company that has a revenue of $1,000, okay? And it is taxed at a corporate tax rate of 30%. That means they pay the government $300. So let's put it in. The government collects $300 from the company. Company profit is $700. Okay. Now, on your side of things, you have a gross salary of $100,000, marginal tax rate of 37%. This is for the Australian taxation world, not the US world. So you end up paying taxes of $25,716, leaving you with a net income of $74,284, which is an effective tax rate of 25.72%. The reason behind this is because Here in Australia, we don't have a flat tax of 37%. Otherwise, you would have paid $37,000. We have what's called a progressive tax system. It goes from, I think, 19% up to 32.5%. Then it goes to 37%, then 45%. So you end up paying a blended tax rate, basically. Okay. Now, let's say that you still have that $100,000 salary, but you've invested in this company. So your total effective salary is the combination of your salary plus what the company revenue is. Now, this point, guys, this is the trick to understanding all of this stuff behind franking credits, okay? Because you being a shareholder of the company, the government does not distinguish the dollars that you earn from your job between the dollars that the company earns, which you own. So you are that portion of the company. So from the government's perspective, just to make it super duper clear, from the government's perspective, the earnings that you're making for that portion of that $1,000, that is effectively treated as your earnings. So your marginal tax rate is still the same, 37%. So you plug that into paycalculator.com.au and you end up with a theoretical taxes of $26,136. Now, don't forget, there's a franking credit associated with that, okay? So what we do is, so before we get to this, so taxes from you, 37% of the $1,000 is $370, right? So we'll put that in there. So the taxes from you is $370. So how much does the government keep? Well, the government wants to keep $370. That's what they're going to end up keeping. So the government always keeps the greater of the two, because in this number here, that already includes 37% of that 1,000, because that's an additional, and that falls under the marginal tax rate. That already includes the $370 in there, and so we can deduct. So the government essentially returns the $300 to you, and you end up paying $300 tax less for a net income of $75,164. Okay, so that leaves you with an effective tax rate of 25.58%. Now, this is the key here, that your effective tax rate has been reduced. That's a win. That's a definite win for us. And we're going to see with more examples later on in the video that that is one of the benefits of franking credits. Now let's go to example 2, and don't worry if you didn't fully understand that explanation there. Maybe you will get it in example 2. So this is a different example now. Same company revenue, taxes, and profits. So taxes paid by the company in this example, $300. So the government collects $300 from the company, put that in there, and your salary is now $35,000 a year, which means you have a much lower marginal tax rate of 19%. You pay $3,192 in taxes, leaving you with a net income of $31,808. So you can see your effective tax rate is also a lot lower. Now, let's say that you own the company, so your gross salary is now effectively $36,000. Your marginal tax rate is still 19%, and you plug these numbers into the paycalculator.com.au, and it tells you that you must pay taxes of $3,402 income taxes. I call this taxes before credit because paycalculator.com.au doesn't know that we own this company, right? They don't know that, but we do. So the tax kept from you by the government based on these calcs is what? Well, you guys know now that it's 19% of that $1,000, okay, which is very easy. It's $190. So what number do you think the government will keep here? The government will keep the higher number. That's how simple it is, guys. The government will keep $300 and they will refund you the $190. They call it a franking credit, okay? So the taxes that you pay will be $3,402 less $190, leaving you with an effective tax rate that is slightly reduced. Again, you end up paying less taxes overall. That's wonderful. So what's the bottom line? Well, the bottom line is that the ATO will keep in taxes the greater of 30%, which is the corporate tax rate, or your marginal tax rate. Okay, so from the ATO's perspective, it treats companies that you have shares in, that you are an investor in. It treats that revenue, that company revenue, that portion that you are responsible for, it treats it as your income. So it taxes that revenue at your marginal tax rate. Now, in some cases where it has already collected tax that is greater than your marginal tax rate, you get a refund, okay? In cases where it doesn't do that, you basically end up paying the full $370 or your full marginal tax rate on that. So I hope that clears things up a lot more for you guys. If you have any questions, of course, please leave them down below. All right, we're going to move on to the next segment. So how much can you expect to reduce your taxes by investing in stocks that have franking credits? And the examples that I gave here kind of hint that you can get a sizable reduction in your effective tax rate. So let's have a look first at super versus non-super. So guys, in this example here, what I've done is I've basically looked at 25 years and a portfolio of $100 starting capital. The other assumptions that I've made about this starting capital in year zero is that it will grow at a compound growth rate of 6% per annum, and that dividends will make up 3% of that 6%, with those 3% dividends reinvested, i.e. 3%, the remaining 3% is capital appreciation. Dividends are fully franked at 100%. I've made that assumption as well. So we've got 4 different examples here for us, and we've got one called super at 15%, your marginal tax rate at 32.5%, 37%, and 45%. So the long story short, guys, is that the results over 25 years of basically letting these investments run without reinvesting, without adding any additional capital to these investments, is the following. Under the lowest tax environment, which is super, you end up with 24% greater portfolio over that time frame. And you can see that your marginal tax rate of 9% and 37% end up in higher results than the baseline, which is the highest tax bracket of 45%. You need to be earning over $200,000 a year, I believe, or $180,000 a year to be in that highest tax bracket there. So what this basically means is that if you plan to own shares with franking credits, shares that pay dividends, and let's face it, a lot of Australian shares do this, you're best off by going hard into your super. And the other thing that's not mentioned by this example, and some of you guys that are more advanced, investors and have been around the block longer than I have, much longer than I have, you will realize that this super example is really, it's technically the accumulation phase of super, which is the phase at which, most of us are in. We pay 15% on any money that we put into super, and also we pay 15% on any dividends earned within our super account. There is also the retirement phase of super, and the retirement phase of super is the phase during which you end up paying 0%. Yes, 0% on some of this stuff. So if we go to some of these articles that you can find on the internet, and they talk about all the big political issue that we had a couple of years ago here in Australia, where Labor wanted to get rid of franking credits for senior citizens and retirees that were already in that retirement phase. Well, there was a lot of backlash from them, and basically the bottom line is that a lot of people voted against Labor, and they voted Liberals in who kept the franking credits for retirees. So that's a whole different story. You can't quite control what government will do. what you can control is electing to invest in the lowest possible tax rate if you can. I can tell you from my perspective that that requires an incredible amount of patience, right? I'm 32 years of age today, and 25 years from now, I will be, approaching my retirement age. But that's a long time to not be able to access those funds. So I elect to, invest out of super more so than I do within super. And maybe as I get into my 40s, my 50s, I will start shifting some of my portfolio into super to then take advantage of that final decade to get me that tax advantage. Hopefully, at that time, super will still be at 15%. All right, guys. Let's move on to the next example, okay, which is going to be basically me going through a whole bunch of different scenarios. So, what I've got here is a base scenario where you can put in different salaries, and you can also put in your portfolio values. So let's say that you are starting out from uni, you're 22 years old, and your salary is $60,000 a year, and you have managed to build up a portfolio of, let's say, $15,000 worth of shares. Portfolio yield, let's say it's 4%. Overall franked rate, for this base scenario, there's no franking credits, and I'm going to show you what happens when we do a same scenario as above, with franking credits at 100%. So effectively, what that does, guys, is that it results in you saving $174 over that year, and effectively reduces your tax rate by 0.36%. Now, let's say that a couple more years into your career, you're on $90,000 a year, guys, and you've built up a portfolio of $60,000, okay? Suddenly, you're looking at an effective tax rate reduction of 1%. All right, let's fast forward another couple of years. Let's say that you're now entering a more, early management phase of your career. Let's say that you're earning $150,000 a year, and let's say that your portfolio is $120,000 for argument's sake. And let's keep everything else the same. Let's keep the portfolio yield at 4% and the franking rate at 100%. All of a sudden, you can see you're now saving $1,300 a year, and your effective tax has been reduced by 1.21% as a result of the franking credits. So the franking credits basically mean that the government doesn't tax you twice on that income. So they've already taxed the company at 30%, as we know from the previous example, and they're not going to tax you even more. So let's step things up a little bit. Let's say now you're hitting about the 10-year mark in your career, and you're earning a cool $200,000 a year, and your portfolio, you've been investing very hard. Your portfolio is at, let's say $400,000 portfolio. All of a sudden, you can see that suddenly we start talking some nice, decent sums of money: $3,700 a year, 2.7% effective tax reduction. Let's say that you decide that going into, in your 15th year of work, that you've maximized your career and your earnings. You don't want to take on that extra risk by going into, senior management or board of directors or anything like that. Let's say that your pay caps at $250,000 a year, and your portfolio by that point in time is $1 million. Okay. So suddenly you can see that from that one example, that this is maybe 15, 20 years into your career, you're effectively saving 5% of your tax every year, and that's just with a quote unquote a $1 million portfolio. Now, let's say that you're 60 years old and you've gone back to work part-time maybe, and you're back on a lower salary, $80,000, but by that point in time your portfolio is now $1.8 million. Well, all of a sudden, there you go, you can see that suddenly your effective tax rate has been dramatically reduced. And this is the beauty of franking credits, that initially, as we saw when I started playing around with this calculator that I made, we initially saw that it wasn't having that much of an impact on your taxes. We started at 0.3% or whatever it was, then we got closer to 1%. Now, in your twilight years, when you're enjoying life, you're just chilling, you may be taking it easier, you're still working. Let's face it, we're never going to stop working. Look at that. Wow. Like your taxes are massively reduced as a result of your portfolio being a 100% franking portfolio. Let's say that it's only 50% because you have US stocks. Well, it cuts it in half, obviously, but still not bad. Not bad. You're still getting that tax benefit, which accumulates over time. The little things end up making a big difference. So, guys, I think this is becoming a very long podcast, almost. So I will leave it at that, and I will say that it really comes down to your overall long-term strategy with your investments, with your retirement, where you plan to retire, which country you plan to retire. But look, if you plan to retire here in Australia, I would definitely advise you, and this is of course just general non-specific advice, I would advise that some franking credits in your portfolio are going to be beneficial from a tax perspective, mainly from a tax perspective, because let's face it, we never quite know whether there is any correlation between shares that are franked and their financial performance over many years. So I hope you guys have enjoyed that video. Hope that you have taken something out of it, and I will see you guys in the next video. Take care.